Welcome to the intriguing world of exchange-traded funds or ETFs. A unique investment instrument, ETFs are used to construct various trading strategies for underlying assets. ETFs permit investors to participate collectively in various asset classes without substantially increasing risk exposure. Thanks to their unique features, high liquidity, and low costs, ETFs have carved a niche for themselves in the capital market. But what is an ETF, you may ask? Picture an ETF as a basket containing several securities that often track an underlying asset. By nature, it's similar to a mutual fund, but it's listed with the markets and trades like stocks in the market. It's an index fund that tracks a benchmark index despite market fluctuations. An ETF is like a portfolio that includes different types of investments, stocks, commodities, bonds, and more, to create a well-balanced place. A popular example of an ETF is the SPDR S&P 500 ETF, SPY, which tracks the S&P 500 index. ETF funds are highly liquid, and their prices move with market trends. This allows investors to buy or sell them at any time during trading hours. ETF funds were introduced in India in 2001. The first ETF based on Nifty 50, launched by Benchmark Mutual Fund, was Nifty B's, Nifty Benchmark Exchange Traded Scheme. Based on the underlying asset class, ETFs are of 6 types. Gold ETFs, a type of commodity ETF that mainly follows gold as an underlying asset sector. ETFs, also known as industry ETFs. It tracks a specific industry, such as technology, energy, or finance. Bond ETFs includes government bonds or other specific investment instruments that qualify as bonds. Currency ETFs allows you to invest in foreign currencies like the euro or the dollar. Inverse ETFs includes a practice called shorting stocks, which means selling shares expected to fall and repurchasing them at a lower cost. Global Index ETF gives investors exposure to both developed and emerging markets to diversify their portfolios. In developed countries, ETFs are predominantly institutional investors in the market, but in India, retail investors enjoy more market share. The primary distributors of ETFs are banks, which find it easier to sell funds like open mutual funds. You need a demat account if you want to sell or buy ETFs, or you can buy from banks. Stocks are a medium to show ownership interest in a company, while ETF is a collection of investment vehicles that can be traded like stocks in the market. Stocks give you more control over your investment, but ETFs give you more market exposure. The commodities featured specifically in ETFs are chosen by professional experts. Mutual funds, MF, and ETFs are similar on many bases, but there are some disparities, especially from the way both are managed. Here's a crucial difference. ETFs trade like stocks throughout the day, but MF can be bought at the end of the day based on the NAV value. MFs are actively managed by portfolio managers. On the other hand, ETFs are passively managed based on a specific market index. So there you have it, a brief overview of what ETFs are. As you continue your investment journey, remember to always take informed decisions and don't be afraid to ask questions. After all, knowledge is power.